please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome. You're watching Power Breakfast on CNBC TV18 in the Mumbai News Center. I am Manisha Jain and with me is Nigel D'Souza. Well, Nigel, good morning. Nifty in the red for the third straight session, sitting at a 1-month low. And even globally, if you look at Dow, that one is sitting at a 3-week low. So just struggling for positive cues.
Absolutely, Anisha. Very good morning, firstly. And in fact, as you said it, we've seen a sharp correction from the top. And the worrying bit is towards the end of trade, we see the selling intensifying, which is a bit worrying. Global cues, as you said, not positive. The US markets at 3-week lows. Interesting trading session. I'm sure the bulls will like to come out on top, but at present, the bears, after a while, they're feeling that they're making some money.
Well, yes, bears certainly in control, and every day we keep on thinking that today is the day.
Absolutely.
We'll probably see the end of the correction rally. That has not happened yet. Let's see whether today is the day or not. But first up, let's run you through the top headlines at this hour. US markets fall to a 3-week low as global growth concerns and tax delay prospects weigh on sentiment. Energy shares led declines as crude continued its slide downward, $55 a barrel. Asia shrugs off the softer lead from Wall Street to climb moderately higher.
And GST green shoots 4 months after the rollout. Revenue shortfall declines by 4,600 crore rupees. Collections also start to pick up. Surprisingly, consuming states are seeing the bigger revenue losses than manufacturing states. That's a CNBC TV18 exclusive.
Government prepones introduction of BS6 grade auto fuels in the National Capital Region to combat the pollution hazard. The BS4 to BS6 upgrade will come into effect from 2018 April instead of 2020. Pawan Goenka tells CNBC TV18 that present engines are compatible with the fuel upgrade.
And 5paisa Capital, hived off from financial services provider IIFL Holdings last year, will become India's first online trading firm to list on exchanges today. Well, it seems Asian markets are shrugging off the softer lead from Wall Street to climb moderately higher in early trade. The Japanese Nikkei, in fact, has snapped a 6-day losing streak, and that's sitting with a gain of close to around 0.5%. The other couple of markets, though, they were more or less mixed just to kickstart trade. So we should get the Kospi up for you. That was holding mildly in the green. Now it's as flat as can be. And the Taiwanese and Straits as well, they had a flattish start just to kickstart trade. But the SGX Nifty, well, the Nifty has seen a big correction in the last few trading sessions. It's indicating a flattish start, but just going by what happened in the US markets, it'll be interesting to see whether or not we do see a flattish start.
Okay, and on Wall Street, the US stocks fell as energy stock sector shares dropped for a 4th straight session, tracking crude prices. Now, the Dow Jones fell 138 points to close at the lowest levels in over 3 weeks. The S&P 500 fell 0.5%, with energy declining 1.2%. Now, while the losses in tech majors dragged the Nasdaq lower, separately, growing uncertainty around tax reform coming by year-end is also worrying investors. CNBC's Hampton Pearson gets us a wrap of all the action on Wall Street.
Technology companies leading a broad slide for U.S. stocks, expanding the market losses from a day earlier. Big tech names, which have so far outpaced the rest of the market this year, took modest losses on Wednesday. Chip maker NVIDIA losing 2%. Companies that make consumer products also were big decliners. Energy stocks, as you mentioned, fell as the price of crude oil closed lower a day after its biggest losses since October. Banks and phone companies rose. Bank of America up 2.1%. At the closing bell, the final numbers on Wall Street on Wednesday. The Dow off 138 points, the S&P down 14, the Nasdaq losing 31 points. Bond prices rose. The yield on the 10-year Treasury fell to 2.33%. The gap between the U.S. short-dated and long-dated U.S. Treasury yields contracted to its tightest in a decade after we had some of that economic data showing a pickup in underlying inflation and an expected rise in retail sales. One other market headline, shares of Target down nearly 10% on Wednesday after the company forecast holiday sales that were below expectations. The move comes despite a big beat in earnings for the big box retailer.
Okay, the U.S. economy delivered a double win for the Federal Reserve with an encouraging pickup in inflation and an unexpected gain in retail sales, further solidifying expectations that policymakers will raise interest rates next month. Now, Charles Evans, the president of the Federal Reserve Bank of Chicago, told CNBC that he expects policy to remain accommodative going ahead.
We've raised the Fed funds target range by 100 basis points, and so that's lifting off from zero, and so that should impart some additional amount of restrictiveness, although policy would be expected to be accommodative given what we think neutral policy looks like. Now, in the meantime, financial conditions have run somewhat easy. Private financial conditions, spreads are lower, asset values are up, and this is a reminder that there are many other events that influence the economy beyond just monetary policy. So even though we've increased the short end of the yield curve's still relatively flat.
Meanwhile, Boston Fed President Eric Rosengren has said that he supports a gradual increase in rate hikes over the next several years. He believes that falling unemployment and sustained growth mean that the U.S. economy has accelerated beyond a sustainable level. So the Federal Reserve should continue to raise interest rates, including next month itself.
Okay, then moving on. So where is the market headed in the near term? Has a recent correction run its course? Here are some global opinion from Michael Wilson, the chief U.S. equity strategist at Morgan Stanley.
I do think this correction has not run its course. A couple things I would point out. First of all, we haven't had anything meaningful this year. We've had a 3% drawdown in the U.S. equity market. That's the biggest drawdown we've had all year. That's the smallest drawdown in any annual year for the last 40. So we're due for something. That's point number one. Point number two is that sentiment has changed 180 degrees from this past summer when people were very nervous about a correction. And look, the good news is now priced, right? It's all the things we've been kind of looking for: third quarter earnings, progress on tax reform, which now looks a little messier, concerns about North Korea probably being a little too extreme this summer now have faded, geopolitical risk in general. Oil prices have actually moved up over the last 3 or 4 months, which is stabilizing that part of the world, the commodity part of the world. Those things are all priced now. We're running about 1.5% core CPI right now, well below the Fed's target of 2%. All we're talking about is a move back towards 2%, which gives the Fed the ammunition to raise rates 2 or 3 more times between now and next June. I think if we see rates rise 3 times by 25 basis points between now and next June, by the way, at the same time they're doing balance sheet reduction, that's a lot of tightening.
Well, in the European markets, they ended low as investor sentiment was hit by the downturn we're seeing in commodity stocks as well as prices. The FTSE, as you can see, it ended with a cut of close to around 0.5%, while the CAC dipped close to around 0.3%. In terms of economic data, the UK's labour market slowed, with the number of employed citizens falling for the first time this year. The jobless rate, remember, was stuck at around 4.3%, but employment fell by around 14,000. That's the first decline we're seeing since October 2016. If you pull up some of those emerging markets, well, yesterday the Russian index was under some pressure. It ended with a cut of close to 1.8% by the time it wound down.
Okay, sticking with Europe, then embattled British Prime Minister Theresa May has called on MPs from all sides of the political spectrum to come together to deliver Brexit. Now, reports suggest that Theresa May is close to offering a deal on money that would unlock the Brexit negotiations. However, Howard Davies, the former Deputy Governor of Bank of England, believes that there is still a long way to go on the Brexit negotiation and bill. Listen in.
EU27 believe that the UK needs to make a bigger offer on the budget before they're prepared to budge. I think the issues in relation to free movement of people, I can't believe are insoluble. The Irish problem, I honestly can't see a solution to it, but equally, I think that that can only be solved by the time we get to the end. So I think the key issue is the budget contribution, and the government's going to have to decide if it makes another offer or not. I think really the only transition can be a standstill where we all carry on as we are until we get to the end point. But there's a long way to go before we agree what the end point is.
Well, and in the currency space, the dollar trimmed losses against a basket of major currencies after data showed a surprise rise in retail sales last month, as well as we saw an uptick in underlying inflation. Now, both these two factors have raised expectations for an interest rate hike in December.
And in the world of commodities, the oil prices continue to remain under pressure after U.S. government agency reports showed that the build-up in the crude stockpiles was larger than estimated. Prices also remained under pressure from this week's International Energy Agency outlook for the slower growth in global crude demand for this year and the next.
Well, and from the precious metal space, gold prices rise as the dollar weakened and U.S. bond yields fell despite solid U.S. economic data that reinforce expectations that the Fed Reserve will press ahead with increases to U.S. interest rate hikes. Back home on the Wall Street, the market continues to steer downwards. The Nifty fell below the 10,100 mark level but saw a sharp recovery in late trade and managed to close to around 69 points in the red. The Sensex, remember, is down close to around 180 points. The mid-cap index, that in fact ended with a bit of a fall as well. Banking stocks saw a relative outperformance in trade yesterday. Ekta joins us early this morning to run us through all the cues that are stacked up. Hi Ekta, morning.
Hi Nigel, like you mentioned, yesterday was quite a tough day for the markets. They closed lower for the third day in a row, and in fact the Nifty was at a 1-month closing low. There was a steep decline that we saw in a lot of the Anil Ambani stocks. So for example, Reliance Communication, Reliance Capital, Relpa, all of these stocks declined by the close of trade. Now in terms of the flows, it was interesting because it was a net sell of around 381 odd crores and a DII net buy of around 869 crores. So maybe the buy on dips sort of fabric that we have seen in earlier months could probably be re-emerging for the markets. We'll probably have to see as we go along. Now, just to put things into perspective, it's not just have in fact declined in 6 out of 7 trading sessions, and in fact we're down over around 3% if you look at it for the past 7 trading sessions. And it's an underperformance as compared to the globe. So for example, the MSCI Asia ex-Japan markets are down around 1% on a week-to-date basis, and compare that to the Nifty, which is down almost around 2%. So there are factors such as, say, the upcoming state elections, crude, though that softened today, and macro concerns such as, say, the exports, fiscal deficit. All of that seems to be weighing on our markets in terms of sentiment at this point in time. If you're talking about us today, the SGX is probably indicating a bit of a flattish start simply because of how much we've probably corrected already. This is despite the fact that, the US markets were at 3-week lows yesterday. The European markets were weak with commodity stocks continuing to be pressured. So that will be probably a bit of a key concern. But if you look at Asia this morning, it's bounced back. So let's see how things pan out. We could start probably flattish, and let's see how we probably pan out. In terms of support levels, I'd be watching out for the 50, 100 and 200-day moving averages. In fact, the 100-day moving average is at 99.74, and most of the technical experts were of the fact that, maybe we're probably going to see a correction now down to around 9900 in any way. And also, I would watch for a decline in high leverage stocks because the likes of Reliance Communication, JP Associates, all of them were down yesterday. I'd probably watch out for those, and maybe the impact that we could see on banks. We haven't yet seen it as of now, but the bank Nifty was quite resilient in yesterday's trading session, but eventually there could be some amount of concerns which could probably emerge.
Okay, Ekta, so that was about the market setup, but what are the key stocks really to look at? You did mention about the ADAG group stocks. They will remain in highlight today as well?
Yes, I'll be watching out for Reliance Communication. They did make some statements saying that the company is still under standstill period until December 2018 under SDR. So there is no payment of interest which is being made to any lenders in that period of time. 5 Paisa Capital is listing on the exchanges, so that'll be interesting to watch out for. Maruti says that they welcome the government advancing the introduction of BS6 fuel in Delhi. So that was a couple of statements coming in. We also, Shireen also spoke to Pavan Goenka last afternoon as well. HPCL says they also would be ready for a rollout in terms of the fuel access at petrol pumps. So that would be something. Raymond is announcing something on their FMCG business. There's a press conference today. I'd be watching out for that. And, the health Canada officials responded to me about Divi's Labs, and they've confirmed that there is an inspection which has begun at their Unit 2 on the 13th of November. But this is now, you know, quite a normal course of business considering that the US FTA has lifted the import alert there.
Well, 4 months after GST rollout, we are starting to see some green shoots. Now, after a mega overhaul last week, the GST Council slashed the taxes on nearly 200 items. But what is even more encouraging is the fact that the revenue collections are starting to pick up and the shortfall is gradually reducing. Timsi Jaipura joins us now. Timsi, what's your analysis of the revenue collection data that is coming up?
4 months after the rollout of the goods and services tax, the losses states are facing is gradually declining. Sample this. Sources tell us that the July collection saw a shortfall of about 12,000 crore rupees. This has come down significantly to 75,000 crore rupees for September. There's another interesting trend. Manufacturing states are seeing lesser revenue loss when compared to the consuming states. Everyone was expecting the opposite to happen, but manufacturing states are not badly affected. Now let me move to the specific states and tell you how they are faring. 17 states have reported a revenue loss of more than 25%. 9 states have reported a loss of less than 25%. The worst hit are Puducherry, Uttarakhand, Himachal Pradesh and Chhattisgarh. Revenue loss for these states and union territories are somewhere between 40 to 60%. Delhi is the only state to see a revenue surplus. Other big manufacturing states like Maharashtra, Tamil Nadu and Telangana have seen a shortfall in just single digits. And finally, the revenue collections are also starting to move higher. For September, the mop-up is now over 95,000 crore rupees. This is 2% higher to the August figures. And also keeping in mind that the number could go even higher, so we are inching closer to that 1 lakh crore mark.
Well, so the revenue shortfall is around 7,500 crore rupees, down from around 12,000 crore rupees in July. We spoke with the man worst hit by the revenue shortfall, the Chief Minister of Puducherry, Narayanasamy. His message was simple. We have our fingers crossed. But there is some optimism as well. The GST Council member from Goa, Mauvin Godinho, believes that things will improve in the next few months.
The month of September, we lost heavily, and also in October we lost heavily. With 30%, then 40%, now 50% has come. Now they have been telling that in the coming months after the reduction in the tax, the revenue mobilization will be more because of the turnover will be more. But I'm keeping my fingers crossed because the government of India and also in the GST Council, whenever we raise the issue of common man consumer goods, the tax should be low. But they did not agree. Now they are agreeing. But we'll have to wait for some time to see whether there will be revenue buoyancy or not.
The income that is going to be generated through indirect taxes, being a service-oriented economy, or where services are rendered, it is more sort of seasonal. After October, that is from November, we expect the revenues to pick up. And come another 2 months, you will see that this particular 41% shortfall will certainly be covered.